Tesla jumped 4.6%. Lab scores at 50 out of 100. Hold. Behind the move is Tesla's massive deployment of 35,000 Nvidia H100 GPUs. This immense compute capacity cements their structural transition from a simple automaker into an AI training powerhouse. Our full hardware teardown reveals whether this massive compute-heavy strategy actually justifies their premium stock valuation. Tesla's autonomous driving Moat is bottlenecked by its custom Dojo D1 chip. It relies on a massive 645 superscript 2 die size. This package cannot match Nvidia's Blackwell in raw compute density. Wall Street prices Tesla as an AI leader. Yet, Dojo's 7nm architecture is falling behind. Dojo utilizes a custom system-on-wafer design. However, its on-package interconnect bandwidth is limited to 1.25 terabytes per second. Compare that to Nvidia's Blackwell B200. It delivers 10 terabytes per second of interconnect bandwidth using advanced CoWoS-L. Tesla's in-car AI4 computer is similarly constrained. It runs on a 5nm node with a TDP of 160 watts. This strict power envelope limits local neural network calculations compared to unrestricted server-class hardware. Today's 4.59% surge to $408.95 was driven by SpaceX Nasdaq IPO rumors, but the underlying engineering reality remains unchanged. Tesla's $1.5t market cap relies on translating raw silicon into full autonomy. Yet, training clusters depend on Nvidia silicon rather than proprietary chips to run FSD. This hardware deficit means Tesla's margins face structural pressure as they buy expensive external GPUs. Quarterly financials showing modest revenue momentum for Tesla. By Q4 2026, escalating global tariff policy will compress Tesla's revenue growth, currently at 15.8%, by at least 300 basis points as supply chain friction intensifies. The macro environment is a crushing wave of friction. While the Federal Reserve holds its benchmark rate at 3.63% and unemployment ticks to 4.3%, delaying anticipated rate cuts, Tesla faces a tightening liquidity squeeze. Prediction markets price recession risk at just 6.6%, yet the normalizing yield spread of plus 0.38% signals capital is growing more expensive. For a high beta asset like Tesla at 1.80, this persistent monetary tightening restricts the consumer credit needed to sustain vehicle demand. Simultaneously, new tariff threats act as a direct regulatory tax on hardware. This policy friction collides with a brutal geopolitical reality. Trump's escalating tariff threats are triggering a broad market sell-off, directly threatening Tesla's globalized hardware supply chains. The core risk lies in how import levies will compress margins on advanced components and CoWoS-L, packaging heavily concentrated in Taiwan. This geopolitical bottleneck threatens the compute infrastructure powering Tesla's autonomous driving ambitions. Socially, the narrative is fracturing. While today's 4.6% surge was fueled by headlines of SpaceX heading to Nasdaq, market skeptics like Steve Eisman are openly panning the IPO's potential. The market is rotating capital away from speculative software moats toward physical infrastructure. Tesla cannot escape the gravity of these supply chain tariffs. The geopolitical wave will drag margins down. Tesla is trading below its 20-day average, currently at 408 point. Management's headline this quarter: record operational efficiency and margin expansion. Three words that appear in every investor deck, every earnings call, every CNBC hit. They're designed to make you feel Tesla is finally harvesting years of R&D into cash flow. They're designed to make you forget the last 3 quarters of delivery misses and the fact that gross margin is still below the 2023 peak. Now look at the insiders. In the past 90 days, they've net sold 55,218 shares. That's not a routine 10b5-1 plan. It's a liquidation pattern. When executives sell that volume after a margin beat, it's not confidence. It's exit velocity. Historically, this precedes a product cycle stall or a capex surprise. And the top 5 institutional holders? They're still buying. That's the tell. The people who built the cars are cashing out. The people who trade paper are doubling down. R&D spend hit $6.4 billion, 6.8% of revenue, up 41% year over year. That's not efficiency. That's a full-blown architecture rewrite. The PR spin calls it next-gen vehicle platform. The lab hears, we're burning cash to catch up on compute and silicon that Nvidia and Qualcomm already shipped. The engineering reality, Tesla's custom Dojo chip is still 18 months behind Blackwell on TSMC 3 nanometers, and the in-house FSD stack is now competing with open-source models that run on a phone. That R&D surge isn't a growth signal, it's a desperation signal. What management is saying is margin expansion. What the lab hears is, we're out of pricing power, and the only way to keep Wall Street happy is to cut costs and pray the next product cycle saves us. The momentum breakdown for Tesla, RSI sits at 49, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Tesla is an AI training powerhouse. It treats cars as edge compute nodes. This fleet-wide neural network training fuels the upcoming Robotaxi reveal. That software transition must justify a trailing PE of 375.2x. But here's what breaks the bull thesis. Cheap Chinese competitors like BYD are flooding global markets. Meanwhile, high interest rates force margin-crushing price cuts, and new tariffs on Chinese components drive up manufacturing costs. If quarterly delivery numbers continue to fall, the hardware foundation funding Tesla's AI R&D completely crumbles. Here is the critical question. Can Tesla scale FSD fast enough to offset falling margins? The lab's answer is no, not in the near term. Robotaxis require regulatory clearance and physical infrastructure that software updates cannot solve. Furthermore, MACD shows bearish momentum. This setup confirms the market is realizing this physical reality, shifting capital away from software promises. Automotive hardware still dictates the valuation. On June 5th, we rated Tesla a hold at $391, and the stock has since risen 4.6% to $408.95. If the upcoming Robotaxi reveal delivers a fully autonomous, regulator-approved platform, expect Tesla to break resistance at $445.27. Nvidia up 1.7%. Lab scores 61 out of 100. Buy. The Blackwell GB200 NVL72 platform pushes 200 TOPS per GPU, slashing inference latency and unlocking next-gen generative AI workloads. That raw compute lift justifies the 1.7% price surge and cements Nvidia's dominance over rival chips. Stay tuned as we dissect die size, packaging yield, tariff exposure, and the AI margin engine powering this rally. Nvidia's hardware dominance is hitting a physical wall because the Blackwell B200 platform requires CoWoS-L, chip-on-wafer-on-substrate with local silicon interconnect packaging technology that connects multiple dies on a single silicon platform, where assembly yields are stuck near 60%. While Wall Street celebrates sovereign AI partnerships, the silicon reality is that Nvidia cannot package these chips fast enough. The Blackwell B200 is not a single monolithic die. It is two maximum reticle-sized dies fused together. This dual-die architecture pulls up to 1200 watts of TDP, thermal design power. The maximum heat a chip can dissipate under workload. This massive footprint demands 8 terabytes per second of memory bandwidth, far outstripping AMD's MI300X architecture. This packaging bottleneck is the real reason the market is consolidating. Hyperscalers are actively developing custom ASICs, application-specific integrated circuits customized for a single, specific computing task to bypass this supply squeeze. At the same time, AMD's ROCm, Radeon Open Compute, the open-source software stack that allows AMD hardware to run AI models, is rapidly closing Nvidia's software moat. Today's 1.73% bump to $208.64 reflects short-term optimism over the Naver sovereign AI deal. However, we see the price hovering just above the 50-day moving average of $203.97. The engineering reality dictates that sovereign cloud wins mean nothing if packaging yields cannot scale. Quarterly financials showing modest revenue momentum for Nvidia. By Q3 2026, tariff policies will compress Nvidia's gross margin by 200 basis points. Import friction will squeeze the supply chain. While Wall Street obsesses over daily stock fluctuations, the macroeconomic wave is shifting. A normalizing yield spread of plus 0.38% and a low 6.6% recession risk show structural resilience. Yet, high interest rates delay Federal Reserve cuts, keeping capital expensive. For Nvidia, boasting an exceptional 85.2% revenue growth, this monetary friction is manageable. The real threat is policy. Trump's sudden tariff announcements have triggered a broad market sell-off. These import levies act as a direct tax on the globalized silicon supply chain, threatening to squeeze margins on advanced packaging. Geopolitics is the ultimate accelerator. Naver tapping Nvidia for South Korea's sovereign AI proves that state-funded tech is the new defensive moat. This sovereign demand bypasses traditional enterprise spending cycles. However, the physical bottleneck remains Taiwan. Almost all of Nvidia's high-performance chips rely on CoWoS. Any geopolitical disruption in the Taiwan Strait immediately halts global AI deployment. This vulnerability is why sovereign states are scrambling to secure domestic hardware. With EPS growth at 214.5%, Nvidia's financial engine is unmatched. But as trade wars reignite, the physical reality of hardware concentration will dictate the stock's ultimate path. Nvidia reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%. A solid beat that signals strong execution. Nvidia Compute is trading below its 20-day average at 200. Management's headline this quarter: significant resilience. That phrase appears in every prepared statement, every CFO commentary, and every earnings call closing remark. It's designed to make investors feel Nvidia is an unstoppable force, immune to macro shocks, supply chain hiccups, or margin compression. What it's designed to make them not think about: the 1.9 million shares insiders just sold in the last 90 days. That's not resilience. That's a liquidity event. Insiders don't sell at all-time highs when they believe the story is bulletproof. They sell when they see the next margin cliff or demand softening before Wall Street does. Historically, this pattern precedes a 15 to 20% pullback within 2 quarters. The official narrative leans on cost improvements and mix to hold gross margins in the mid-70s. But here's the decode. Colette Kress's answer to Stacey Raskin's margin question was 147 words of corporate filler before she even named the real cost driver: memory. She never quantified how much of the margin defense is pricing power versus supply chain pre-buys. Meanwhile, R&D spend hit $18.5 billion, a 43% YOY surge, now 8.6% of revenue. That's not efficiency. That's desperation to outrun commoditization. The silicon reality? Blackwell's die size is 2.5 times Hopper's, and TSMC's CoWoS yield is still below 70%. You don't spend $18 billion on R&D when your packaging bottleneck is solved. You spend it when you're terrified the bottleneck isn't solved. Last quarter, Jensen Huang called demand insatiable. This quarter, he pivoted to, our supply chain has known our requirements for a long time. The momentum breakdown for Nvidia. RSI sits at 39, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Nvidia's bull case rests on the Blackwell GB200 NVL72 platform. This architecture integrates custom CPUs and Tensor Core graphics processors. The stock trades at an attractive forward P/E, price-to-earnings ratio, projected price divided by earnings, of 16.5x. Massive generative AI infrastructure demand secures near-term revenue. But here's what breaks the bull thesis. Thermal failures or yield drops in TSMC's CoWoS packaging will halt Blackwell shipments. CoWoS, chip-on-wafer-on-substrate, the advanced packaging technology that stacks silicon dies, remains a critical bottleneck. Strict export controls force reliance on lower-margin H20 chips. H20, modified graphics processing units designed to meet regulatory caps, will compress gross margins. What is the physical limit to Blackwell's rollout? It is not demand. The bottleneck is HBM3E and CoWoS packaging capacity. HBM3E, high bandwidth memory, the ultra-fast stacked dynamic random access memory interface, has tight supply. Wall Street models infinite growth. Yet physical packaging reticles limit quarterly shipments. If TSMC cannot scale packaging slots, Nvidia misses revenue targets. Order backlogs will not save them. Our PR analysis shows executive language shifting from demand to execution. This linguistic pivot signals supply constraints are worse than admitted. Our June 5th buy call at $205.10 is up 1.7%. However, our June 1st buy at $224.36 sits down 7%. If Blackwell volume shipments scale smoothly over the next 2 quarters, the stock will challenge resistance at $235.47. If packaging yields or thermal issues delay shipments, expect a swift correction to support at $205.10. The lab's call: we favor the upside path. Our AI score of 61 out of 100 reflects this conviction. Unprecedented demand will override these near-term supply chain bottlenecks. Today's top signal shows Nvidia's momentum outpaces Tesla's near-term outlook. If you had to pick one between Tesla and Nvidia right now, which one and why? Comments open. This discussion is for educational purposes only, not a recommendation. You should conduct your own due diligence. And remember that past performance is not indicative of future results. Markets can shift rapidly, and individual risk tolerance varies, so personal analysis is essential before any trade. Always consider your financial situation before acting. Stay sharp, and we'll see you next time.